what does the rescue of Credit Suisse mean for these bondholders, and what are the broader implications? Joining us now to discuss, NewEdge Wealth Portfolio Manager and Head of Fixed Income, Ben Emons. And Ben, thank you very much, because part of that explanation there was sourced from some of your explanation that you had emailed to us. So when we were talking about these bonds, why is there such a kerfuffle over these bonds? Why is there so much, what is the deal? Why are people so upset about these?
Hi, Julie. Yeah, I think what happened here was that people did assume they were senior to the stockholder. And the reason was that after the financial crisis and after the European debt crisis, these securities were issued. They became part of the bank's capital to bolster the capital under the assumption that that would be leading to the position of the bank in excess capital versus required. And then the ECB, of course, supporting the banking system with lots of liquidity and banks buying sovereign bonds that went up in value and the ECB buying those sovereign bonds. All of that led to a capital position in European banks where those AT1 securities were issued for that was assumed not to meet any kind of write-down, no matter what would happen. And this is now what is not the case. What the Swiss regulator did was to say, if we're going to have a transaction at 76 Swiss francs per share for Credit Suisse to merge with UBS, the bondholders have to pay up here because the capital shortfall that would happen as a result of that transaction has to be made up by regulation. And if you then dive into that prospectus, as you mentioned, it's very clearly outlined in bold letters, like you have the risk to be written down completely to zero in the event of that sort of distress. And I think as a last point, the regulator here took a discretion to judge this because the prospectus also outlines this. You cannot have a situation where the taxpayer must step up for a merger or distress event. It must be the bondholders. And I think this is why people are upset. They didn't realize this. And now you're seeing the fallout in the markets, particularly that particular market, AT1 bonds.
How abnormal or even precedent-setting is the move that the regulators have taken within this decision?
It is very significant, I think, because as we now understand that these securities can be written down to zero, you cannot assume they are quote-unquote safe securities. People look back at the return of those securities, which, by the way, have been exceptionally high. They've done extremely well if you've held them in your portfolio. That is obviously not what you can expect going from here. The yields of those securities have to rise materially to account for that risk of write-down, even though that maybe some of the banks that have issued those bonds will never have to write down those securities. Nonetheless, the risk have to be repriced. And you can see this now in the spreads of those securities, whether they're issued by German banks, Italian banks, or French banks. The spreads are all up about the same amount, something like 300 to 500 basis points last time I looked. And I tell you that we're going to be at a more higher yield and spread level for these securities from here.
Ben, I'm curious, did you own any of this stuff?
No, fortunately, I did not. We're more involved in senior unsecured that is not with connected to any write-down clause. I want to make point here too that in the United States, these securities are not issued this way. They call preferreds, and they're senior unsecured as well, but they don't have any clause to be written down in any type of event. So I think people can look at this like a really European-specific issue across a number of banks. Again, to your earlier question, the broader risk implications that these banks have issued those bonds, they will go down in value, so they have to do something with their capital because they're part of the capital. On the other hand, the broader bond market seems to be less affected by this at this moment. I'm talking particularly financial senior unsecured debt. So, yeah, that's where we're at the moment.
At the same time, is it going to be more expensive for banks, not just in Europe, but globally, to do business as a result of this?
I think we could say that because there's uncertainty about the banking system overall. Lots of not really clear language about what is this FDIC limit on deposits, for example. Also, the merger between UBS and Credit Suisse being pointed to that this was actually caused by the distress in the regional banking system in the US. And as much as you can argue whether that is not or is, I think that all of that uncertainty drives up the cost of funding for banks. And as a result, you will see central banks pumping in, liquidity into the banking system just to make sure that they're not going to be a major distress. Nonetheless, I think the cost of funding for banks will stay higher from here because of all these uncertainties that are surrounding it.
You've written that there's less likely contagion from the AT1s to U.S. bank preferreds, but there's also some carry through to what this means for U.S. large cap bank stocks. So what would that be from your perspective?
Yeah, there's always a form of correlation between the markets, no matter what. Because if one bank doesn't do well, it just affects all banks everywhere. People judge it like that risk in Europe that's increased must also be accounted elsewhere. But I do think you're not dealing with obviously the similar situation because there's no write-down clause in these securities here in the U.S. I do think that the U.S. banks become obviously larger here, will get more deposit inflow, but also be perceived as banks that are even more systemically important than before. So that designation, which played a big role here with this UBS Credit Suisse merger, is something that for investors is important, because if that were to be watered down, then I think we're getting even more distress than we're experiencing currently.
One other quick thing I want to mention is, we've been talking all about the bondholders. The equity holders, they didn't get nothing, but they didn't get much, right? In terms of this UBS acquisition of Credit Suisse. The Saudi National Bank, which, as we talked about last week, is a big holder in Credit Suisse. They lost something like $1 billion on their investment. So in the wake of all of this, from an equity perspective, how are you thinking about investing in the banks or not investing in the banks?
Well, you can certainly invest in banks. I don't think that this is just all out and done, and therefore, you have to completely rotate out of financials altogether. But it does indicate, the winners and losers, the strong versus the weaker banks. And this has been a process, I would say, dates back even from the 90s, when you saw a lot of mergers, and then on to the financial crisis with its mergers, and now again. So I think the conclusion is that you could probably see a new wave of consolidation coming through. Fair bit of data is out there on that type of, how many consolidation could happen, because it is about scale of economy and about, money on the move, the seeking for, well, if my money is not safe at one bank, I'm going to go to the one that I think is safe. And that's what individuals will do and what investors will do. So I do think that banks are an opportunity to invest in, but you have to do your homework, and people look again at metrics of debt and metrics of equity and determine there if these banks run sound lending models and have limited leverage. That's probably an opportunity to invest in.
NewEdge Wealth Portfolio Manager and Head of Fixed Income, Ben Emons, joining us here today. Ben, thanks so much for the time. We appreciate it.
Thank you. Thank you for having us.